record this. Yeah, good. So I'm recording it. If you want the video, you can always get it. So, well, the example, the investor isn't forced to buy the euro against the USD, against the United States dollar, which would be the longer euro USD trade. And they can instead buy the euro against the British pound by going long. So when you see a euro versus USD, if you put money as an investor, you are not forced that every time it will be a buy as a USD. A lot of people, when they think USD, they think it's just a buy. Remember, on these two currencies, it says it quoted with another. So this currency quote with this one. It means if you think that the dollar is losing value, you can actually shorten the dollar. Or if you think the dollar is actually gaining, or the pound is gaining, is losing also value, you can actually longing the dollar. Then you make money by the euro shorting up. I don't know if it makes sense. Makes sense. Okay, so on an instrument, there's two chords. On a one instrument chord, you find two instruments, right? As what we said. So the first one, it's a base currency. The second one, it's a chord currency, right? Remember we said this is a base currency. You cannot measure euro USD alone, how much it's worth it, unless there's a different currencies that you quote with. So this one is called a base. This one is called a quote. In a simple question, if you are buying euro USD, what instrument are you buying? Are you buying euro or are you buying USD? Anyone? Anyone? Guys, come on.
When you are buying euro USD, you mean to say the USD is losing power, then the euro is gaining power.
Okay, you're actually close, very, very close. You are there. You are there. Anyone? Euro USD. We said this is a base currency. You cannot measure a value of the base currency without a quote currency that will quote how much this one worth, right? It's like you find two women, you know, all of them, they're beautiful, but you look, you know, something like that. So when you are buying euro USD, are you buying a euros or you are buying USD? You are buying a dollar. Unmute. Unmute the mic. All right, cool. Let's cut it short. Let's cut it short. So you can also type. If you don't want to unmute, you can type on a chat. It's fine. So look, it actually means you are buying the euros because the euro is the base currency. It's an original currency, right? You're not buying a dollar. You are actually trading a euro, right? So some people, they will see a trade like this, euro USD, but they will start maybe selling, thinking that they are selling the USD, or they are buying, thinking that they are buying the USD, while maybe the euro value is losing power. Immediately the euro value is losing power. Even if you buy, thinking that you are buying a USD, you're not buying USD. Now you are playing with the euro. So you want to be in a loss because of you think the euro is going up, but the euro is going down. So when we are trading this instrument, we are trading euros. Same as this one, Euro GBP. When we are trading this one, whether we are shortening or buying, we are actually trading euros. We good there, right? This is what I was talking about, a base versus the code currency. One important distinction of the forex code is conversion. The first currency listed in the court is known as the base currency on the pay. And this is the easiest that being quoted. The second currency in the pair is known as the court currency. And this is the conversion of the court, or the currency that is being used to define the value of other currency in a pair. I think we're 100% together there. Angeke umunye imento ikambe manga ne. No mentor should lie to you guys. When you see the signal and they say buy or sell, we are selling $1, you must say no, it's not the best currency, most that one. Okay, here we go. Any question, guys, we ask immediately. So for example, explained in a nutshell, the forex exchange market works like many other markets in that it's driven by the supplier and the demand. Using a very basic example, if there is a strong demand for the US dollar from Europe citizens holding the euros, they will exchange their euros into dollar. The value of the US dollar will rise while the value of the euro will fall. Keep in mind that this is the transaction between only affected by the euro and the USD. A currency pair and will not fall, example, cause the USD to depreciate against any other currency like a Japanese yen. It's the simple picture of FX trader, a bank or a broker, money coming back to you. Yeah. Okay. So now we need to understand how does the forex works. I think this is the recap to a lot of people, but it's always nice to recap because you pick up something new, you know, that you didn't know, and you can use that moving forward. You know. So this is very similar to other markets. If you think the value of the currency is going to go up, appreciate, you can look to buy the currency. It's also known as long. If you feel like the currency is going to go down, depreciate, you can sell that currency. You know, that is also known as going short, right? So it means in a forex market, you can be able to go long or you can be able to go short. All right, to those that we don't know, we're also live on Instagram. You can follow us on Instagram. It's the Daily Money Market, or my only handle page, which is Che_Yusuf. So if you want to see most of these things, can be able to get me anyway. Okay. All right. So as example shown, you buy at lower level, you sell at a higher level. Buy at lower level, you don't buy at a higher level of the market unless you are looking for another higher level that will be happening. If you are expecting another higher level happening, then you can buy expecting that the market will go to the higher level, but you always buy at the bottom, you sell on top. Buy at the bottom, you sell when it's on the high. So this is pretty much simple strategy that you can use. Sometimes the mentor can send you a signal, but maybe the market already passes where it's supposed to be. The mentor sent you a signal when the market was here, and the market goes all the way passes, and then you realize the actually, you know, the signal while the market on the half, and you want to continue buy. You buy a little bit, and then before you actually be happy with the profit, it will reverse. You get back on a loss, and then you say the mental signal is not working. All right. So simple thing, how to trade when you are busy. I know most of the people, they always say that I'm busy. You know, I don't have time to look at the market. I don't have time to actually trade every day. There's always a way of actually getting in the market and trade, even if you are busy. If you are too busy, follow the news and monitor the charts all day. it is possible to participate in a forex trading in easier and less time consuming way. So the social trading allows you to connect with the experienced traders, see their performance statistics, discuss their trading ideas, and learn from their mistakes and copy their successful strategies in a sense of making a professional work for you. So there is a certain product that we call social trading or a copy trading, whereby you can be able to copy a certain individual based on his statistics, based on his analysis and how he's been performing for past month, and then you just watch the market, you just watch where the market is going, right? Another thing, what it says there, you can trade the news instead of just trading every day. If you are busy, you can just focus on the specific days that they actually have the news days. Then it has a higher impact day that you can make a good profit on a day. Then you leave, you wait for another couple of days when there's a news again. So you decide whether you want to trade a big news or you want to trade, whether it's a small news or big. It's absolutely, up to you guys. So there's always a chance of trading, no excuse. All right, so here we're getting into a little bit of technical. This is a little bit of technical. The heart, it's a leverage. So it says the heart of trading, it's a leverage, pips, and spread. Who know what leverage is? Anyone in a simple term? A leverage in a forex market. All right. So in a simple term, a leverage, it's the money that you borrow for a broker to boost your account, but doesn't mean you're gonna pay the broker, right? So each and every instrument that is being traded in the market, it's calculated into dollars. So I want to show you guys something. Okay, let's see. Okay, so if you look at it, let's say for example, NASDAQ, it's sitting at 11,365. 11,365, these are dollars. $11,365. And you and me, we don't have $11,000 to be able to get in the market and to start actually trade this instrument. But why is that we trade with our 1,000 rand, our 500 bucks, our $100? It's because we're being leveraged by the broker, right? We're being leveraged by the broker so that we can be able to afford to trade this type of instrument. So that's what a leverage means, right? So we're gonna go into a little bit of technical stuff. If you don't understand, don't worry. We can the recording is there, and we can always come back in another day and do these things again, right? So, which represent a margin trading ratio. So it represents the margin trading ratio, enables the traders to borrow a certain amount of money that allows them to trade in a much bigger deals. Moreover, a leverage allows one to trade using more money than they have in their forex market. So you can be able to participate in the market with a higher volume than the amount of money that you have. So if you were going to Johannesburg Stock Exchange and you want to buy Sanlam shares, and Sanlam shares, it says it's 2,000. It's 2,000. You have to give them 2,000, right? While in a forex trading, if you want to buy Sanlam, let's say the same example, right? And it's 2,000, you can get leveraged by the broker and be able to actually, afford that instrument. Hey, ladies and gentlemen, I only have 10 minutes left. I hope I'll be fast enough to finish the session. All right. Therefore, your leverage Your account's balance to place a bigger trade currency rates moves very slowly. This makes a small trades unfashionable as they only retain a small profit and the losses, right? For every pip, rate it changes. Therefore, the leverage helps one to trade in a larger deals, hence amplifying their potential profit and as well as the loss. So again, the trick about the leverage, the higher you take, the higher you lose, the more money you lose, right? The smaller you take, the more money you lose. It gives you a little bit, a better in terms of stability of the leverage. Then the second one is the pips, because it tells us the heart of the trading, it's a leverage pips and the spread. The second one is the pips, right? Who know what pips is in a simple term? Guys, all right. In a simple term, let's put it in a simple term. Pips, it's a point in percentage. A point in percentage. It's a point, but it's being rated in percentage form, right? So we're going to break down what it is. A price interest point representing the smallest change in a currency pairs. So it actually represents the changing from 5 to add a 2. For example, to 3 grows to 5 to add as a 6. So it's the changing of the price, but it moves with a pip. What added? It's a pip. What do you make in the forex market? It's pips. You don't make money, you make pips. The pips are being translated now to money when it comes to a broker in terms of paying you. But what do you make? It was just pips. All right. Typically, it is the 4th decimal point, although many brokers quoted using the 5th decimal point. However, the 5th decimal doesn't really affect the price and it changes really quick. So a currency pair that includes the US dollar, a pip is 1.10,000, 1/10,000 of a dollar. Whereas when the currency pair includes the yen, a pip is 1 to 100 of a yen, because the yen, it's a closer in a value to 1 to 100 of the major currencies. So the yen has a little bit of more power. That is why the calculation when you're trading the yen, it's a little bit of, it looks a little bit expensive than when you're trading any other instrument, because it's close to 1 to 100 of United States dollars. If there's any question, you can type on the chat box, no problem. The last one is the spread, right? Anyone? Spread, any idea? This one is very tricky. People, they explain the spread in a very, very different way. Some, it's different, but we're going to get to it. So in a forex trading, a broker's quote the bid and the asking price for the currencies paid. The bid is actually the price that traders can sell the base currencies, which the ask is the price they can buy the base currency. So if you understand earlier on, we're talking about base and the quote, right? A base and a quote. Now we're talking about the difference between a base and a quote now. What is the difference between these two, right? So a spread refers to the difference between the two prices. Besides, this is how the no commission brokers, those who do not charge a separate fee on a trader's transaction, make their money. The spread is measured in pips. Most currency pairs, the base currency and the quote currency, have a pip value equal to 0.01. For instance, take the following quote of Euro USD at 1.1151/53. The spread is 0.0002, which equal to 2 pips, right? I don't know if we get it there, but I want to show you guys on a market. So what it was explaining there, it's a difference between the bid price and the asking price, right? If you take this number minus this number, you see this one is said 24.68. This one it says 25.31. What it means, there's a difference of a pip and a pip and a half. When you are trading, this is what we pay to Globex 360. This is the payment of Globex 360 for us to be able to give you this platform and to participate in a global market. So each and every brokers, they're like that. They always have, pips. They always have markup that is being added so that they can also make a profit and they can continue with their trading. All right. Any questions on the pip and the pip value and the spread? Okay, how to read the currency pairs on the pip. Here it is, as we say, the base currency and the quote. Currencies are traded in a pair as their value is related to one another. The first currency shown in the controlling one in terms of the pricing your order. So if you see Euro USD, then you are always choosing to buy or sell the first currency euros, which is we already explained about this one. If we see these two, we are choosing to buy or sell this one. So you might find also currency pairs that are called majors, right? They're called major instrument or major currency pairs, right? The majors are widely traded by the beginners and the professionals alike. This is because they have the most liquidity and the lowest spread and the broadest range of the movement. And likely, small currency majors are generally more stable. The economic and the political institutes of this national are generally long established and predictable compared to one another. So the major currency pairs, I think a lot of people, it's Euro USD, USD JPY, GBP USD. Those are the major currencies, the currencies that are actually really, really close to each other in terms of the value. They're called the major currencies. So you might find the main to say that I only send the signals of major currencies. You should know there's always a dollar in that type of a currency. So you must always look at the dollar, how it's actually, performing at particular time. Then there's the crosses currency, the crosses pairs. The crosses are any currency pair that doesn't feature the USD and they do not hold any less profit potential than the major ones. Too much US dollars exposure can lead to all your trades heading in the same direction. A big problem if the direction is against you. So here it's very, very important to understand these ones. Most of people, they always trade a dollar-based currencies, USD something, NASDAQ, US 30. You are all trading one particular economic movement, maybe, if I may say. So if the dollar falls, your whole trades, you're out of the game because you are trading instrument based on one particular area, right? This is where it helps you to diverse your portfolio, trading a different instrument, trading maybe something like GBP Australian dollar, Swiss franc from France. If anything happened with a dollar, you still have your analysis going on the other instrument. Then the last one is the exotic. The currency pairs are less traded and so much more closet to buy or sell. Don't let the cost put you off because many of these greatest traders of all time made their fortune with exotic pairs. Exotic pairs, they're very, very expensive pairs. For example, one of the 5 greatest forex trader, George Solo, again, $800 million profit from selling their BHD in 1997 and Asia crisis. So this is exotic because it's Asia, it's unknown. A lot of people, they don't trade that. USD ZAR,